Welcome to today's Explainer. If you're managing your own portfolio right now, these recent AI tech market swings, they're probably giving you total whiplash. I mean, 1 minute the market is absolutely soaring on these incredible tech breakthroughs, and literally the next minute, everyone's screaming about massive pullbacks. So today, we're putting on our financial expert hats to give this a totally objective diagnosis. How exactly do these wild signals impact your everyday asset management? We're going to dive into the live data, strip away all that emotion, and figure out what the headlines and, more importantly, the hard numbers are really telling us about the AI sector.
To kick things off, we really got to ask a kind of strange question. Right in the middle of this massive, unprecedented AI boom, why is the phrase AI profit-taking suddenly absolutely dominating search trends? Live trend data pulled from Google News is showing a massive spike in people looking this up. It's a total paradox, right? When things are going this great, why is there this sudden, super measurable undercurrent of anxiety? Well, this search trend is basically a real-time reflection of retail investor panic. And honestly, it highlights a critical moment where emotional investing can just completely derail a solid long-term asset management strategy.
2%. It sounds so small, right? But that is the number that just sent total ripples through the financial world. Recently, a major headline went around saying the Nasdaq dropped 2%. And the reasons popping up in the live data feed? A really messy mix of profit-taking in AI stocks, heavy inflation fears, and rising geopolitical tensions in the Middle East. Look, for an individual investor, a 2% drop is exactly the kind of volatility that triggers those premature flight-to-safety reactions. People get spooked by the news and start cashing out their massive AI gains. But as we're going to see, reacting purely on emotion means you're missing half the story.
Section 1. The two faces of the market. Navigating contradictory headlines.
Okay, to really grasp what's happening right now, we have to understand that there isn't just one single narrative playing out. On one hand, you've got this narrative of fear, profit-taking amid Middle East tensions pulling the Nasdaq down. But literally on the exact same day, in the exact same live news feeds, a totally opposing reality pops up. Headlines claiming markets are completely looking past those US-Iran tensions because AI and tech stocks are driving record highs. It is a literal contradiction. One side says geopolitical tension is causing a massive sell-off. The other side says the market is completely ignoring that tension because the AI boom is just too powerful to stop.
So as objective observers looking at the data, we have to officially categorize the current market status as disputed and incomplete. Seriously, these live trend data points, they're just market noise. As of right now, we do not have a single confirmed settled fact to end this debate. And if you're an individual managing your own assets, making trades based on disputed live feeds is incredibly dangerous. The most concrete, practical strategy here is patience. We really can't treat the doom narrative or the boom narrative as a settled fact just yet.
Section 2. Hints from the hardware. Tech earnings driving the boom. All right, so if the geopolitical headlines are just noise, where do we look? We need to look at the actual engines driving the tech sector, corporate earnings data. $22.2 billion. That is the massive Q2 revenue figure that Broadcom, a huge player in the semiconductor space, just reported. But here's the absolute critical detail. Broadcom managed to pull in this massive revenue while keeping their operating expenses perfectly flat, no increase at all. For a retail investor, seeing a company scale their revenue without scaling their costs, that's exactly the kind of fundamental metric you want to look for when deciding if a tech stock has real, long-term viability past the initial hype.
And that brings us right to the dominant questions circulating all over the financial news right now. Is Broadcom stock a buy after Q2 revenue reached $22.2 billion and OPEX held flat? You see, this question is a massive driver of that positive market sentiment we were just talking about. It's not based on rumors or speculation. It's a question forced by a hard, fundamental earnings report that's making investors stop and wonder if they're missing out on some verifiable, real-world growth.
And you know what? This hardware boom isn't just an isolated event. Our data is showing a huge surge in shares and incredibly strong growth outlooks for major Asian hardware players too. Specifically, giants like Samsung Electro-Mechanics and LG Innotek are really riding the wave of this massive AI chip demand. What this tells us is that the physical infrastructure needed to actually run artificial intelligence is creating robust, totally verifiable growth all across international supply chains. So if you're looking to steady your nerves in this volatile market, this kind of global supply chain health is an incredibly strong counterweight to all those panic narratives.
Section 3. The Everything Exchange. Coinbase's AI Evolution.
Now, hardware is really just the foundation here. Let's shift gears and look at the platforms, because AI integration is shaking up market strategies and policies in ways that directly impact everyday retail traders. According to recent reports, Coinbase is laying out this massive vision to become what they call the everything exchange. They're planning to introduce tokenized stocks, which essentially bridges the gap between traditional equities and blockchain tech. Practically speaking, this kind of platform policy shift means way greater market access and liquidity for ordinary people who are just trying to manage their own investments.
But here is the really crucial part. They're also planning to integrate a dedicated AI advisor. Think about that for a second. An AI advisor represents a gigantic evolution in consumer finance. It's designed to guide your trading, analyze the markets, and completely personalize your user experience. For the ordinary investor, this means the kind of institutional-level analysis that used to be reserved for Wall Street pros might soon be right in the pocket of the everyday retail trader. It's completely leveling the playing field for personal asset management, and honestly, this forward-looking expansion is exactly why that record-high market narrative just won't go away.
Section 4. Separating fact from market noise. What to watch next.
All right, let's wrap this up. If you're a focused learner out there trying to protect and grow your assets in this wild market, here is your concrete, step-by-step response strategy. Number 1, acknowledge the contradictory headlines. Just recognize that the media is currently disputing the reality of the market. Number 2, tune out the geopolitical noise and focus strictly on verified corporate earnings. And number 3, wait for the official filings. True confirmation only comes from Tier 1 sources. We're talking official US SEC filings or DART filings over in South Korea. Seriously, make waiting for those filings your ultimate golden rule for individual asset protection in a volatile market. Because until those numbers hit the official ledgers, everything else is just conversation.
Which leaves us with one final, absolutely vital question to ponder. As we stand at this crazy crossroads between fear-driven profit-taking and massive AI-driven corporate growth, what official data release is finally going to tip the scales of this contradictory market? Is it going to be the next major tech earnings call, or maybe a new macroeconomic inflation report? Keep your eyes glued to those official filings, because for the everyday investor managing their portfolio, that is exactly where the true story and the true value of this AI boom is finally going to be written. Keep learning and invest smart.